Women have outperformed men at investing. Here's what the data actually teaches us. Fidelity analyzed more than 5 million investment accounts over 10 years and found that women outperform men by an average of 40 basis points per year. That's 0.4%. The difference was not better stock elections, superior market timing, or access to better information. It was simply behavior. Women traded less frequently and were more likely to remain invested during periods of volatility. Those habits are not specific to women. They can be adopted by any investor. In this video, I'll explain the research, the behaviors behind the performance gap, and how to build those investors into your investment process. My name is Soho Fini. I'm a certified financial planner, and I help people make important financial decisions. Here's what the research found. Fidelity's 2021 Women and Investing study examined 5.2 million accounts from January of 2011 through December of 2020. Women outperform men by an average of 40 basis points annually. That may sound insignificant, but small differences compound over time. For example, $1 million portfolio growing at 7% annually for 25 years would reach approximately $5.4 million. At 7.4%, it would grow to approximately $6 million. That's a difference of more than $500,000 without contributing another dollar. See, the 40 basis point does not seem insignificant anymore. Other studies have reached similar conclusions. Research from UC Berkeley found that men traded more frequently than women and earned lower net returns as a result. Warwick Business School studied 2,800 investors in the United Kingdom and found that women outperform men by approximately 1.8% annually. That's close to 2% a year. Wells Fargo also found that women generated stronger risk-adjusted returns while taking less risk with their portfolio. The portfolios themselves were not necessarily better. The difference was primarily in how investors behaved after the portfolios were built. You got to keep in mind that trading more does not mean investing better. Economists Barber and Terence Odean analyzed more than 35,000 brokerage accounts. They found that men traded 45% more frequently than women. 45%. That additional trading reduced men's annual net return by 2.65% compared to a 1.7% reduction for women. Among single investors, the difference was even larger. Single men traded 67% more frequently than single women. Odean also studied what happened when an investor sold one stock to buy another. On average, the stocks they purchased underperformed the stocks they sold by approximately 3.3 percentage points over the following year. The issue was not a lack of intelligence or information, it was overconfidence. Investors frequently believe they can identify which investments will perform better next, even when the evidence does not support that conclusion whatsoever. Each trade introduces another opportunity for poor timing, taxes, transaction costs, and emotional decision-making. Let's dig into those. Being more active can feel like being more responsible, like you're doing something. In investing, the two are not necessarily related or supporting of each other. I also want to introduce something that almost exclusively impacts men. The industry encourages different behavior. There may also be an environmental reason men trade more frequently. For decades, investing and trading have largely been marketed to men. Research examining 7 decades of financial advertising found that men appeared as the central figure in 84% of advertisements. Of course, that number has improved over the last decade or so. Men were generally presented as knowledgeable decision makers, while women were more often shown in secondary roles. The language around this matters so much and impacts how people behave. Investment marketing frequently emphasizes competition, winning, risk, speed, and beating the market. Those messages do not simply encourage people to invest. They encourage a particular version of investing built around action and doing something about stuff. These show up like trading more, finding the next opportunity, being quick to the market, move before everyone else does, outperform the market. That distinction matters quite a bit because long-term investing and active trading are often marketed as though they are the same activity while they could not be more different. A person repeatedly exposed to the idea that successful investing requires constant attention and decisive action may be more likely to trade even when trading is completely unnecessary. This does not fully explain the behavioral difference between men and women, but it may reinforce it. Men have historically received more messages inviting them to participate in markets, while those messages have often presented participation as competition. Women may have been underserved by the investment industry, but they may also have been less exposed to the specific marketing that encourages investors to mistake activity for skill. The performance difference may not be entirely about individual tendencies. It may also reflect how the financial industry has taught men and women to think about investing. The cost of selling during volatility. The second important behavioral difference appears during market declines. Women, on average, have been less likely to exit their portfolios during periods of volatility. Selling during a decline creates two unnecessary decisions. Number one, you must decide when to sell. And number two, you must decide when to re-enter the market. Now, the second decision is often more difficult to make. Investors tend to sell after losses have already occurred and wait to reinvest until the market and economic outlook feel more stable. It's been well documented that investor sentiment and market returns are at odds. By then, a meaningful portion of the recovery may have already taken place. Remaining invested eliminates the need to identify the bottom or determine the correct re-entry point. That does not mean an investor should never sell. It means that changes should be based on a financial plan, not the emotional conditions of the market. To dig a little deeper on this, the difference in the results cannot be reduced to one explanation. Overconfidence, trading frequency, reactions to volatility, and the way investing has historically been marketed may all contribute to this outcome. The useful conclusion is not that women are naturally better investors. Maybe it has something to do with their wiring, maybe it is social factors. The more interesting thing we're looking for is that certain behaviors have produced better outcomes. Trading less, remaining invested, and treating investing as a long-term process rather than a continuous competition. Women have demonstrated those behaviors more consistently on average, but the behaviors themselves are theoretically available to everyone. And here's how you build these behaviors into your portfolio. Number one, create a written investment policy. Your investment policy should define what you own, why you own it, your targeted allocation, when you will rebalance, and the conditions under which you will sell. These decisions should be made before markets become volatile. When a proposed change does not align with a written policy, you might want to pause. Maybe you create a 48-hour waiting rule for yourself. The purpose of the delay is not to prevent every trade. It is to distinguish a considered decision from an immediate reaction. Number two, use a predetermined rebalancing process. Rebalancing should occur according to a schedule or a defined allocation threshold. These are things that are built into a systematic trading schedule. For example, you might rebalance annually, quarterly, or when an asset class moves more than a certain percentage from its target allocation. A predetermined process reduces the influence of current headlines, recent performance, and personal conviction. The portfolio returns to its intended allocation because the policy requires it, not because the investor is attempting to predict what happens next. Number three, reduce how often you check your portfolio. The more frequently investors review their accounts, the more frequently they experience short-term losses. That repeated exposure can increase the temptation to react and in some ways gamifies your investing. For long-term investors, a monthly or a quarterly review may provide all the information necessary to monitor the portfolio without turning normal volatility into a series of unnecessary decisions. Your review schedule should reflect the purpose of the money, not the volume of the financial news you're receiving. Number four, match the portfolio to the financial plan. Remaining invested is easier when the portfolio is appropriate for the investor's actual needs. Money required in the near future should not depend on short-term stock market performance. Emergency reserves, planned withdrawals, and other near-term obligations should be accounted for separately. The investment allocation should also reflect the investor's time horizon, income needs, and tolerance for risk and volatility. Many behavioral mistakes begin with a portfolio that was too aggressive for the person holding it. And number five, introduce accountability. Important investment decisions should be reviewed with another person before they're implemented. That may be a spouse, business partner, or a financial advisor. The role of that person is not simply to approve or reject the decision. It is to ask whether the decision is consistent with the plan and why it needs to be made now. A good advisor does more than selecting investments. An advisor can create distance, much needed distance between an emotional reaction and a permanent financial decision. And ultimately, you build a process that does not rely on willpower. The objective is not to eliminate emotion from investing. While that is ideal, it is also unrealistic when it comes to human beings. The objective is to create a process that remains functional when emotions are highly elevated. Write the investment policy before volatility occurs. Automate what can be automated. Review the portfolio at well-defined intervals. Match the investment risk to the purpose of the money. Require an additional review before making significant changes. These systems reduce the number of decisions an investor must make under pressure. In conclusion, the headline is that women have historically outperformed men as investors. The more useful conversation here is why that is the case. And here's why. They traded less frequently and were more likely to remain invested. They may also have been less exposed to a version of investment marketing that equates success with action, competition, and constant trading. A difference of 0.4% per year may not appear meaningful in isolation, but over a long period of time, it can produce hundreds of thousands of dollars in additional wealth. Long-term investment results are not determined only by what you own. They're also determined by how often you interfere with it. As always, if you found this useful, like this video and subscribe to the channel. And if you would like my team to review your portfolio and financial plan, use the link below to schedule a complimentary consultation. I'll see you in the next one.